Okay, two things. Today is an important session because there have been quite some changes in the One Big Beautiful Bill when it comes to the filing requirements, filing status, and the dependents. Now, in yesterday's file, there is only just a couple of small changes I made because I wanted you guys to lead on to what we are going to discuss today. So actually, I've made 3 changes in yesterday's file and I've uploaded the new file on the LMS. Now, what is the first one? Now, this was already there, but I've still emphasized it a little more. When we spoke about the QSS yesterday, we said that the taxpayer must have maintained the house, which must be the principal place of residence for the qualifying child, who must stay with the taxpayer for the entire year. We had already discussed it yesterday. Now, when you're saying you must maintain a house, typically it means maintaining house for more than half of the year. Okay, we are not, when we describe what is maintenance, we are looking at paying more than half of the cost of keeping the house. That is a definition of what is the maintenance of the house. Okay, so that's the first change I made compared to last year. One second. So that's the first change that we made compared to what we wrote yesterday. Now, yesterday, Shikha had mentioned this, right? So generally we never used to mention this, but this time I think it will be great if we can mention this. So I have mentioned that if the child is in the college, that is technically termed as a temporary absence, which might include also something like illness and vacation. So even if there's a child who's studying in the hostel, and if you are maintaining the house, which is a principal place of residence for the child, that would still make you a qualifying surviving spouse. And then the last change that I made, and this is, Rajesh, if you remember, we were discussing this yesterday, and this is what you spoke about, right? The fact that, and I didn't want to introduce this yesterday, but I did it today so that now we can lead it on to the next topic, which is dependence. When you're thinking of an HOH status, or if you're thinking of a qualifying surviving spouse status, it is very important that the person you're talking about must be claimed as a dependent on your return. So if you see the child, the mother, father, that's the parent, and the relative must stay with you for what? For more than half of the tax year, and that person must be claimed as a dependent. So please remember, these are very small stuff. More or less, it is similar to what we did yesterday. But I want to emphasize on the term dependent. Without being a dependent, you cannot claim any person as an HOH. Now with this, I'll quickly refresh what we did till yesterday. We spoke about the fact that we are dealing with Form 1040. And we said that Form 1040, the first thing that we need to understand is who is eligible to file Form 1040. So we said there are three categories of people. The first category are people who are earning more than the amount that is legally allowed as a deduction, as a standard deduction. Second, we said if you're a self-employed and if you're earning equal to or more than $400, even then you'll have to file your return. And the third was a dependent who would have an independent return of his or her own. Even that person will have to file his or her own return. What was the due date? We said the due date for paying taxes is always April 15th. But if you have some difficulties, you can file a form, and by filing that form, there's an automatic extension of 6 months, which is October 15th, for you to file your return, but that extension never applies to the paying of taxes. We did this. Then we went to the concept of filing status. Single versus married filing jointly. We discussed what's the difference. It's a single day test that's important. Also, we spoke about how at the end of the year, if you be a married filing jointly couple, you don't need to prorate the marriage, the birth, or the death. We also spoke about, wait 1 second. Yeah, Rajesh, that's a good question, but I'll touch upon this. We also spoke about married filing separately, which are the compulsory. So we spoke about 2 scenarios where an MFS return becomes important. And then we spoke about, and we also spoke about the fact that when you're filing an MFS return, there's so many benefits that will be pulled off. You will not be able to avail those credits. Then we spoke about the married HSA, the qualifying surviving spouse, and the head of the household. Who's a qualifying surviving spouse? In the year of death, it is always MFJ. 2 years thereafter, you could have a QSS provided you have a dependent child, and that child must, so this is what we spoke about, right? So provided you have a dependent child, and that dependent child, you must have maintained the principal place of residence for that child for the entire year. This is the only place where the definition of child excludes foster child. Okay, one more thing that I wanted to add was, generally, the Act did not mention words like nieces and nephews in most places. But this year they've clarified, if it's a niece or a nephew, you do consider it as a part of your lineal descendants, unless and until it is mentioned. So see your MCQs and see how they're treating nieces and nephews. But now they have categorically put those in the terms and the definitions of child. So niece and nephew would also be considered your child. Okay, so we said that if you had, so basically you can take the advantage of married filing jointly rates and double standard deduction by claiming a QSS return. Then we spoke about head of household, and head of household can be applicable only if the other, you have maintained a house which is a principal place of residence for another person who must be a qualifying dependent. If it's a child, the child must live with you for more than half of the taxable year. If it's a relative, the relative must live with you for more than half of the taxable year. But if it's a parent, only remember this has to be only for a parent. There is no requirement that the parent has to stay with you. So we did 5 qualifying status. So yeah, Rajesh, it's not necessary that the residence has to be owned. Even if it's a rented residence, it does qualify. Okay. So till now, anybody, any questions? Because see, what I want you to understand is understand the provisions well for both, for filing status, and now I'm going to extend and talk about dependence to you. But I want you to have these as separate provisions in your mind. And when you apply these provisions in a case where both of it has to be done simultaneously, go back to your own concepts. Go back to these 2 concepts individually and apply the scenario individually. We'll do one very good sim in a live class today, which will club both of these concepts. And we will do dependence. We'll understand the provisions for dependence. We will do a sim which will club filing status and dependence together. If there is time, I will do one more sim with you, which covers one very interesting scenario once again. So, but let's talk about it, okay? Anybody, any questions from yesterday's class? Okay. Community property state for married filing separately. Do we need to remember? No, it will never. See, one thing, Rajesh, I want to tell you is, so his question is, for community property states, do we want to remember the names? CPA, especially CPA as an exam, will not test much of your memorizing skills. So very rare. So they will never question you on which form are we talking about, which are the states. Even if the need is there, they'll give you the name of the state. They will mention it's a community property state, and then they will ask you to apply the provision. They will never test your rote learning skills. Just remember that. Okay. Okay. So today what we're going to do is now tax rates, no. In certain cases, standard rate. I will let you know as we go along what you have to memorize, what you don't have to memorize, okay? But tax rates, no. They will never ask you to calculate the taxes separately, okay? So what my suggestion is, as we are going along, as we are solving the sums, for the places where the information is required, I will give you those, and I will also mention what needs to be memorized and what isn't important, okay? So today what we are going to do is, we are going to discuss 2 concepts. First, we are going to talk about dependence. Understand there are some big changes that has happened in the definition of dependence after the introduction of one big beautiful bill. And chances are that you will get a sim in this area. If you get a sim, I'm pretty confident after whatever we will be doing in the class, there will be no concepts which will be new. Okay. The only thing is, don't be aware of when you are mugging up and when you are understanding. There's a difference between recollection and reasoning. We should always ensure that you could reason in the exam and not recollect. Because if you depend on recollection, for sure you are going to make mistakes in your exam. And then, before we go on and discuss other topics, I would want you to give you a big overview of what we are going to do for individual taxation for the next 10-12 classes to come. Okay. Now see, Dependent. So we know that. Why is dependent important? Okay, now please understand that dependency as a concept was repealed when Tax Cut and Jobs Act was introduced. And I explained that to you yesterday, right? So if you look at the form now, okay, if this is the form that we're talking about, can you see they still want you to give the details of the dependents? And what details they're wanting? They're asking you to give the first name, last name. They are wanting you to give the SSN number. What is the relationship of that dependent with you? Check if lived with you for more than half of the year. So we know that for dependency, it's important that the criteria is for more than half of the tax year, the other party is staying with you. And you need to let them know whether this person was a full-time student, whether this person was permanently and totally disabled. And now this is the key here, guys, okay? I want you to remember this. The only reason why you need to have dependents now is this and this. The definitions of qualifying surviving spouse and HOH does not hold true till the time you have not defined whether the other party is a dependent. So that's the reason we still want to know whether there are dependents who are staying off from us. And second, there are a lot of credits like child tax credit, other dependents credit, where the credit would be available only for that child or that dependent who's technically your qualifying child or your qualifying relative. So for two reasons, we still need the definition of dependents, and the IRS form 1040 still wants you to give that information to the IRS, not for claiming a personal exemption, which was earlier the case, but for first defining whether you're a QSS or an HOH. But please remember, in any case, you're not going to have the residence requirement of more than half of the tax year. And second, there are credits. When we go to the credit section, then we will understand how these credits unfold. So these are the two reasons why we are still studying what's a dependent. Now see, who is a dependent? We say it's a qualifying child or a qualifying relative. In my opinion, the best way to do this is if you can remember the acronym. See, the acronym works really well. Okay, why? Because yeah, for QSS, it's for the whole year. Yeah, but see, what my point is, if you have to define a dependent, the dependency is for more than half of the year. And whether because of that dependent you can get a QSS, that is for the entire year. Is that okay, Shikha? That's the reason when you're defining a dependent, they don't want to know whether you were there for the whole year or not. Have I answered your question? Okay.
Ma'am, it's a little confusing.
Sorry?
We have to maintain the house. It's a little confusing, ma'am. Do we have to maintain the house for the whole year, right?
You have to maintain the house. No. See, you have to maintain the house for more than half of the year, but the dependent should stay with you for the entire year. See, okay.
Okay.
But what I'm trying to explain you is here they are not questioning you on QSS. Here they want to find out whether that person is a dependent. So there are two provisions. Is there a qualifying child? So is he a dependent? And then is that dependent qualifying as a QSS? Are you understanding? So for the dependent, the only requirement is that guy should have stayed with you for more than half of the year, if it's a qualifying child. If it's a dependent, there's some other. We'll talk about it. After that, you'll have to see an additional thing that if it is a QSS, it has to be for the full year, that the child has to be there with you in your house for the entire year. Is that okay?
Got it. Okay.
Yeah. Okay. Now see, the best way this works is, and I know these might not look like a really good acronym, but this is the best that I could make. If you can use something else of your own, you can do that. Okay. But it's important that each one of these provisions should be crystal clear to you. Okay. So there are provisions. Each of those provisions, if they are met, we will say that this is a qualifying child or this is a qualifying relative. So there are two kinds of people who could be claimed as dependent on your return, either a child or a relative. For a child, the acronym is a residency scope. So it's A, R of residency, and SCOPE. What are these? First is, please understand the key word is the child must be younger than the taxpayer. That's very, very important. Whoever you're claiming as a dependent in your return should not be older than you. As simple as that. And not only older, cannot be of the same age as you, has to be younger than you. Second, that person has to be less than 19 years. So if it is exactly 19 years, is that person your qualifying child? What do you say? If that person is exactly 19 years. So please remember, it's a law And law has to be complicated, okay? Law has to be complicated. It has its own turnaround and a roundabout way of talking. So remember, if it is younger, it means it has to be less than. Also, in some of our MCQs that we have seen for, let's say, the enrolled agents course, they will tell you, okay, now this is very rare, but if they give you, so let's say I talk to Janvi here. Janvi, when is your birthday? You are the youngest in the entire group. Okay, so Janvi, when is your birthday? Quick. Yeah.
4 July 2004.
So 4th July. Can you tell me on which date will she turn? So let's say if I'm talking about 19th, okay? And just imagine hypothetically that Janvi is 19 years of age, okay? This year she's turning 19. So if her birthday is 4th of July, on what day is she turning 19? Can anybody tell me? On what day is she turning 19? If her birthday is on 4th of July, no Hanuman, it will be 3rd of July. She will turn 19 on 3rd July, not on 4th July. Is that okay? Because she will complete 19 years of age a day before the birthday. Okay, so we had a question in my enrolled agents section where we had this question. Okay, so remember, very importantly, the person should be younger to you as a taxpayer. The person should be less than 19 years. Do you have to remember the limits? The answer is absolutely yes. They will not give you these in the exam. The person has to be less than 19 years of age. If you're a full-time student, you are allowed 24 years. So see, what we're trying to tell you is either the person who's a dropout, then till 18 years, I will consider that person to be your qualifying child. If that person goes and joins a university, then in university in US, the university is for 4 years. So 19, 20, 21, so 19, 20, 21, 22, if you're taking a 5 years course, 23, but definitely not 24 and above. So if you're a full-time student, the age is less than 24. And if you're a permanently disabled child, then there is no age limit. Now, who is a full-time student? I have this written as a note, but just to explain you, technically, and I don't think that they'll question you on this because this is like getting too many levels below. Technically, they say that for any part of the 5 months, the child must have been a full-time student of an educational institution. And an educational institution is one who's running a full-time program, must have at least one full-time faculty, okay? So when we say at least 5 months, a part of 5 months, not necessary that full 5 months full has to be there. So imagine if it's a last year of graduation for a student, Jan, Feb, March, April, 4 months the child went for the school. Only on 1st May the child went and got the graduation certificate. But till 1st May, the child is enrolled in the university. So we will say, okay, Jan, Feb, March, April. And 1st of May, that means part of May is covered. So I will say it's 5 months done. The child qualifies for the age limit requirements. Do you have to remember this? See, when you solve questions on this, after 5, 6 questions, this will get in your mind. But yes, you will have to remember the provisions really well. So first thing is the child should be less. So first is age limit or residency scope. The child has to be less than your age, must be less than 19. If not a full-time student, must be less than 24. If a full-time student, and no age limit if the child is permanently disabled. Second, now this is important. The residency should be the same as the taxpayer for more than half of the taxable year. And remember, we spoke earlier, temporary absences are permitted. So staying in the college, taking a vacation, falling ill, all allowed. And they will not hamper the residency status of the individual. Third, now this is the key. Okay, start this. Earlier, now see, there is a history. The history was earlier, there used to be a lot of problems about, you've seen the movie King Richard, which shows about, or which talks about the Venus and the Serena Williams sisters being trained by the dad, whose name was Richard, right? So imagine a student like that, who's earning a lot of money, but still staying in the parent's house. And still the parent is providing more than half of the support of the child, right? So we said that, see, if the child is earning a lot of money, the parent should not be devoid of taking the dependency for that child. The only thing that I want to show is the child must not provide more than half of his or her own support. So it's very clear that till the time the child is not funding for more than half of his or her own support, you would go on and treat the child as a dependent on your return, provided other provisions have been fulfilled. The child must be closely related to you. Now here, especially this year, they have detailed it a lot. Again, in my opinion, just keep a very broad perspective in your mind. When you say child, it is you, your children, your grandchildren, brother, sister, their children, grandchildren, anybody in your direct blood relationship. But it will not include up. It will only include down. So your parents are not included. Your grandparents are not included. In-laws are not included. Cousins are not included. Is a stepchild included? Yes. Is a foster child included? Yes. Remember, the only place where foster child is not included is in the QSS definition. Else, everywhere foster child will be included. Okay, this is very important. It has to be only for citizens or residents of US, Canada, and Mexico. If there is a child who's not staying in any of these places, then we are not going to regard that person as a qualifying child. Okay, this is important. The child should not file a separate return as a joint return with anybody else. So imagine a 18-year-old daughter who goes and gets married and files a joint return with a spouse. In that case, that child, even if she's staying in your house and even if you're providing more than 50% support of that child, you would not be claiming that child as a dependent in your return. There's a very small exception which says that, see, imagine if last year the child was in your return, okay? This year the child has to claim some refund. There is nothing else apart from the fact that the refund has to be claimed. So in case if she's a joint return, but the purpose is only to claim refund, no further amount needs to be disclosed. In that case, we will not say that just because the child has filed an MFJ, there would be no child dependency given to the child just because there is a separate return file. So we're saying, except for the fact that whatever you did earlier and now you're claiming a refund, for no other reason can the child go and file a joint return with somebody else as a spouse. Okay, this is important. I don't care how much money is the child making. So in any question where child is concerned and they give you the money, please understand that for a child, it makes no difference how much money is that child making. So remember Venus Williams. I think Venus was some 17 years old when she cracked her first big Nike contract. Doesn't make a difference, okay? So a residency scope. Age limit has to be less than 19 or 24 or unlimited if it's a full-time, if it's a disabled child. Younger than the taxpayer, must be staying in the same house as yours for more than half of the tax year. The child must not give more than half of his or her own support, must be very, very closely related to you, must be the citizen or the resident of US, Canada, Mexico, cannot file a joint return, and I don't care how much money is the child making. All of these conditions have to be met. Okay, Shikha, all conditions have to be met. Only if all is met, can you say that the child, okay, let me just write it here. All to be met. If all of these conditions are met, I'm going to say that the child is a qualifying child. And you can claim that child as a dependent. And then if that child is staying with you for the entire year, and if the spouse has died in the last year or last year, you can claim that child as a QSS. Or if you're single, legally separated, or an abundant spouse, you can claim that child as a head of a household. I mean, for the purposes of head of household. Then comes the question of who's a qualifying relative. A relative is any child who should have been a child, but for the fact that either the age went up or, the child is not meeting the age requirement, or that child must be studying abroad and not being a resident. For any reason, the person is related to you by blood, but you cannot take that person as a qualifying child. Immediately, it becomes a qualifying relative. Okay. Apart from that, parents, grandparents, all of that now becomes open for the criteria of qualifying relative. Now, this is again same. The relative cannot file a separate return as a joint return, except if it is for the purpose of claiming a refund. Only citizens of US, Canada, Mexico, or the residents thereof could be claimed as a relative. Now, this is the most important provision for the relative. Now, what it says is either that person has to be related to you by blood, or that person must have spent the entire year with you in case if you want to take as a qualifying relative. Now, see, what do you mean by this? Let me just explain this to you. We said that if there's a friend, you remember we did a question yesterday for filing status where we said that there was a person whose friend had come. So imagine my sister goes to US and a college friend of hers goes and stays with her, and she does her PhD at her place, and she is the one who's supporting that friend of hers. Now, in that case, we ask ourselves, is that person a qualifying child? Never. Is that person related to my sister by blood? No. Is that person living with that taxpayer for the entire year? Yes. So this is the only place where if you're not blood related, then there's a requirement that that person can be taken as a qualifying relative, provided that person stays with you for the entire year. Remember, for the relatives, it's not required. For the relative, there is no requirement of staying with you for any part of the year. If it's related, we don't need you to be staying with us. Okay? Okay. Then it is, okay, this is again a very important. So either a relative or the taxpayer must stay with you for the entire year. Okay, this is important. This is really, really important. Now, what they say is, okay, first look at an example. The example is, let's say I'm a taxpayer. I have a parent, let's say my father, and I'm supporting my father. And my father is a relative, so my father need not stay with me. And if my father is staying away, then they say, okay, my father is having a lot of passive income of his own, a lot of income. Okay, so let's assume he has had a lot of these the houses that he got and he put them on rent, books that he wrote, he got royalty, had a lot of investments, got dividends. So we say, okay, now this dad, even if I'm providing the support of the other person who's my father, and I know that father is not required to stay with me, is that person earning a lot of taxable income of his or her own? If the answer is yes, then we don't need to, provide him as a relative or a qualifying dependent on your return. So we say it's very important. What kind of income is that relative earning? If that income is taxable, we would want that person to file his or her own return. We would not want you, 1 second, guys. So we would not want that person to file, to be claimed as a dependent on your return, because that person is capable of filing that own return and the money is taxable. It's a big amount of money. So we say it's very important that if it's a non-taxable amount, I don't care. So if you're getting money from Social Security, tax exempt interest or municipal bond interest or some scholarship which is not included as part of taxation, then I don't care. You can earn any part of tax exempt income and you can still be claimed as a dependent on somebody else's return. But the moment it becomes a taxable income, then I want you to not include that person as relative on anybody's return as a dependent, but that person should go and file a own return. So it's very important that it is not all income, but only taxable income, which should be less than $5,300. And this is very important. I want you to compare the two. I'll show you. There's a very nice slide that I'll show you later. What's a support test saying? The taxpayer. Now, here we are very clear that you can take somebody's deduction only if you've provided more than 50% support of that other person. So the acronym that we're using at SUPORTUS, PORTUS, cannot file a separate return, so precludes filing a joint return. Only citizens of Mexico, Canada, and US can apply. Either that person must be related to you or that person must live with you for the entire tax year. The person should not have a taxable income of more than basically should have taxable income of less than $5,300, and you should have provided more than 50% support of the other person. So whenever you get a question on either of these, first just write the acronyms and then tick, cross, tick, cross, tick, cross. Ultimately, you'll get your answer. Yashika, unmute yourself.
Ma'am, I have a small question.
Yeah.
Yesterday, when we were discussing the HOH status, under HOH, we said that it is mandatory for the relative to stay with us.
Yes.
The relative and the child, not the parent.
Yes.
But here we are saying that for a qualifying relative, the relative need not stay, even though they are related by blood, but the other person should stay with us. So then,
Yes.
I mean, how do we differentiate?
Okay, see, okay, what I have to do, is you wait. Let us first do the examples and then you'll come back. But see, what we're trying to tell you is first think of both these provisions separately, Shikha. Okay, if you try mixing them, it will not help you. What we were telling you about HOHs. So what was the purpose of HOH? You are single, you're taking care of somebody in your house, and we want you to take a better benefit of income tax slabs. Do you agree, Shikha?
Yeah, yeah.
So there we made it very clear. If there is any person who's not related to you, we are not going to even consider this separate tax slab for you. Agreed?
Yeah.
So a friend comes in, not allowed. HOH not possible. Even if there's a child with a divorced parent, HOH can be claimed only by the custodial parent. That's it. Right? For that
Yeah.
reason, we said that if I want to be claiming myself as a head of household, that household has to be for the child who's staying with you for more than half of the year. Is that clear?
Right.
Clear.
Right.
Done. Leave it. Then we come to a definition of qualifying relative. Qualifying relative. So again, see, I can give you a lower base and then I can increase it, right? So I'm saying a qualifying relative is a person. So think about an uncle or an aunt who is related to you by blood. Is that okay?
Mm.
So let's say if it is an uncle or an aunt, that person cannot be a qualifying child, will be a qualifying relative, right?
Yeah.
So here it is not needed that that person has to stay with you, right?
Yeah.
But then if you want to claim that person as an HOH, there's an additional requirement that you must have maintained the house for that person for
Oh.
more than half of the year. Same as QSS that we spoke about earlier, right? We are defining a base level requirement for HOH for dependency, and then we are increasing some other provisions to get you take a QSS status or the HOH state. Is that clear?
Got it.
So
Yeah,
for
got
an
it.
HOH, that person has to stay with you for more than half of the taxable year. For qualifying relative, if it's a relative who is related to your blood, and so imagine, I'll give you some examples and this will make it very, very clear. And when I'm doing that, that's the reason deliberately I mix the dependency and the status together in the sim so that all this confusion will go away. But remember,
So
this is the
basically,
base and then we will build on that. Yeah.
got it. So in conjunction, both of the provisions in conjunction, we'll have to see.
For the HOH, right?
For
For the
deciding whether
HOH.
it's
Yes.
HOH or
Yes.
QSS. Okay.
So
Okay, got
again,
it.
that is the reason I told you that I added the 3 words today, right? It has to be a dependent child, dependent parent, dependent relative. So first dependence,
Right.
then HOH. Is that clear?
Got it. Got it. Got it. Thank you.
Yeah. Again, I want you to just register all of these provisions now because without this, I cannot even go to the sim. But I think it will be after the sim when all of these problems will get sorted. Now, this is very important. I showed you in the form that they're asking for an SSN. So a taxpayer has to get an SSN for any dependent who has attained the age of 1 as of the close of the tax year. So you have to show the SSN for any person who has to be included as a dependent on your return. Now, this I've just explained you. I've written it down for you. A full-time student is a student who attends an educational institution for at least, please don't forget the word part. Part, that means even 1 day is a part, okay? Even 1 day is equal to a part. So any part, we are not saying part thereof in excess of 6 months. We're not saying that. Part thereof means even 1 day extra will be taken as the month. And minimum of 5 months you need in a year for the person to be called a full-time student for that particular year. Okay. So it's very important that for qualifying relative, either you need to have a relationship status or there has to be a resident status. Either of the two would be okay, but residence is required if somebody is not blood related. Relationship is required if you want to claim a relative who's not staying with you, but whom you are supporting for more than 50% of the tax year. Now, the question is, which is a very important question, what is support? Now, support typically means economic support, the cost that you are funding. So the funding that you are doing to help that person do whatever that person is doing. So it can be money, it can be items, it can be amount sent on items like food, clothing, shelter, medical care, dental care, insurance, whatever is. So imagine this amount is not guided by the quantum. So if you are a tennis player, then your support would include those sessions that you're going to take with those world-renowned tennis players, right? So in that case, those classes, even if it's very costly, becomes a part of your necessity. So this is determined on a case-to-case basis. So whatever is needed to support that person. Now, please remember, this is not the same as maintaining a house. This means funding for the upkeep of the other person and providing for his or her necessities. Now, this difference for support has become prominent with the One Big Beautiful Bill Act. What was earlier also was very clear that in case of a qualifying child, we are saying that the child must not provide more than 50% of their own support. And I don't care how much money is the child making. But for qualifying relative, we turned the table. We said the taxpayer should provide more than 50% of the support of the relative. Now, again, these are some very, very minute provisions. I have given you some examples on this in the SIM so that this becomes clearer. But what I'm trying to tell you is, again, this provision was not made keeping qualifying child or relative in mind. What I told you was, if it is your own child, now see what we're trying to say. We are trying to see what is the amount that is needed to support a child. And then we are calculating 50%, 20%, whatever that figure is coming. What is the support you provided versus what is the total support which is provided? And if it is more than 50%, then it's a qualifying relative if you have provided that support. And if it is a child, you want to make sure that the child is not funding more than 50% of his or her own support. Now, there was a provision that got introduced in One Big Beautiful Act which said that, see, if that person is your child, and your child may be a qualifying child or a qualifying relative. Isn't it, guys? Give me an example of a child who is your child, but will not be a qualifying child, but will be a qualifying relative. Can you tell me? Give me an example where it is your child, but your child will not be a qualifying child, but a qualified relative. Can you tell me? More than 19 years? And so if it is more than 19 years, then what would happen? Qualifying child, no. But child, yes. And if that child, if you're providing more than 50% of the support, that child becomes your qualifying relative. So we are saying, I don't care whether the child is a qualifying child or a qualifying relative. For the purposes of determining the percentage of support, if it is your child, I will do away with the process of calculating their scholarship and including it as a part of the total support calculation. So just hear this now. When we take a question, you will get a practical example and we will do it from there. So what they're saying is, it is so basically your denominator will get reduced because you are excluding the scholarship. See, disregarded or so scholarships are disregarded or excluded when determining if a full-time student who is a child or a stepchild provided greater than 50% of their own support. But the moment it is anybody but your child, so if it is your brother's child, if it is your sister's child, grandchild, all of them, you will keep including scholarship in the total support. This distinction is only for your child, whether it is a qualifying child or a qualifying relative. So see what they're saying? Again, it will be excluded if the relative is a full-time student and a child or a stepchild of the taxpayer. I've given you a very good example where that person is a child but not a qualifying child. And only it will be counted as outside support for non-child relatives. So what we are saying, again, general rules, scholarships are included when you're calculating total support, except if a qualifying child or a qualifying relative is your child or stepchild. Only in that case, we will not include scholarship as a part of the total support. I'll show you two examples where this concept will be driven home. But right now, just remember, just kind of register this provision so that when I introduce the case to you, this will become easier. Social Security and welfare will only be included to the extent you have actually spent that money. So how do you calculate the support? It is the amount that was spent for the support versus the total support that was needed for that particular child. And if this is more than 50%, we say that the child is becoming, or that parent or that person will become your qualifying relative. If the support is provided to more than one parent, then you will have to compute support for each parent separately. And if in a house there are a lot of members who are staying, and then if a support cost is being incurred, you will have to divide it amongst all the members, guys, right? Not just one person. And that member can include dependent, and that particular dependent share you will consider for that dependent. Okay. Now, see, I don't think that they're going to dig that deep and give you questions with so much of details. I've given you all the provisions, the ones which are most commonly tested and the ones which would be important for you to answer the question correctly. We will share that with you via a SIM right now, okay? So just hold on. Remember, we'll get back to these provisions once we've done the SIM so that it becomes really simple for you to understand. Now this I've already explained. Ideally, the dependency exemption has gone away, but we will still need the dependents because the HOS status and the credits are applicable. Who's a qualifying child? If the parents, okay, now this is very important. If the parents of the child are entitled to claim the child, but they do not. So the parent is not claiming the child. No one else can claim the child unless that person's AGI is higher. Okay, what I'll do is, guys, let me take this in first, okay? Because then this theory will become really simple for you. Can you guys open the second SIM and tell me whether you're able to open it or not? Just open the second SIM and tell me whether you're able to open that SIM or not. It should not ask for your email ID today. Just let me know. Did it ask for your email ID today? Are you guys all able to open the SIM? Hanuman, no is for, okay. So the SIM is there. Yeah, you were able to open it, right?
Yes.
Okay. Mute yourself. Let's take this question. Okay, this is very important. If you would have understood this question, there's nothing in this that you would not have understood. Okay, what we'll do is we'll take the questions one by one and we'll take the add-ons or the notes at the end. Okay. For each independent scenario, indicate two things for the current year, which is 2026. How many number of individuals who meet the definition of a dependent, either a qualifying child or a qualifying relative, and the taxpayer's most advantageous filing status. Unless otherwise stated, all the parties are US citizens or residents. Each taxpayer pays more than half the cost of maintaining the home referred to, and married taxpayers file jointly if eligible. Note that a person can be a dependent without being a qualifying person for head of household. Take the first scenario, okay? D is single, keeps a home for the 19-year-old son, Ellis, who is a full-time college student who lived with him except while away at school. He received a 28,000 tax-free scholarship that paid his tuition and dormitory costs. Apart from the scholarship, E's support for the year cost 12,000, of which D paid 9,000 and E paid 3,000 from a part-time job. How many dependents may D claim and what is her filing status? Now see, the moment you get a scholarship, ask yourself, is that person your child? If yes, scholarship amount is going to be excluded. So first thing that's important is C, D is single. So I'm talking about a person who is single and keeps up a home for her 19-year-old son. Okay. Is the age criteria being met? We say a residency, SCOPE. A 19-year-old son, Ellie is a full-time college student who lived with Dana except while away at school. So what was the age requirement? Less than 19 becomes less than 24 if the person is a full-time student. So is the first condition, is it met? The answer is yes, met. Residency, yes, met because it is away only for education. S is support test. Now this is what we'll have to figure out. Is that person paying more than half of his or her own support? So what is the support being paid? What is the total support? See, he received 28,000 tax-free scholarship that paid his tuition and dormitory costs. Apart from the scholarship, E supports cost for the year is 12,000, of which Dana paid 9 and Ellis paid 3 for a part-time job that the child did. Now what we are doing, we are excluding the scholarship because the person concerned is the child of the taxpayer. So we will remove this 28,000 from our consideration. So this goes away. The moment this goes away, what is the total amount? The total amount is 12, out of which the taxpayer is paying, 9. That means you're providing more than, the child is not providing more than 50% of his or her own support. So how much is the child providing? 3 out of 12,000, which is 25%. Child is not providing more than 50% of his or her own support. So what will be the support test? Is it met? The answer is yes, the support test is met. C is closely related to you. Yes, the child is closely related to me. Yes, the child is a citizen of US. No, the child is not filing a separate return and precludes filing a joint return. And what was E, guys? One second. Yeah. Eliminate the, I don't care about the gross income. So this child is making 3, but that is not something that is of relative importance to me. So very clearly put, is the child a qualifying child? The answer is yes. So first, is the child a dependent? The answer is yes. What is the status of this person? Can you tell me? So yes, I have one dependent. And what is the status of this person? Can you tell me? Very good. Now can you understand? Yes, you are maintaining a house for more than half of the tax year is the principal place of residence of the child. And yes, that child is staying with you, he's away, but that temporary absence is permitted. So the child will be taken as a H. So your status becomes HOH and the child will be claimed as a dependent on your return. Is this clear to everybody? Anybody who has not understood what is scholarship? How are we applying scholarship here? Anybody in that zone, please ask me now. Have you understood how to apply? I would suggest, this is a confusing topic. Please write it one by one, tick, crossed, and for every provision, use the, for every situation, use that provision and only that provision. Janvi, have you understood this? Janvi, unmute yourself. Is this clear?
Yes, ma'am.
Yeah. Everybody, Shwarna, is this clear?
Yes, ma'am. Yes.
Yeah.
It is clear. Yeah.
Now I want you to do one more question with scholarship. There was another question. Yeah. Yeah. Look at question 3, guys, now, okay? We are comparing the scholarship of a child with the scholarship of a relative. And now let's see what is the third one telling you, okay? We are reading the third question now. Bethany is single and helps support the 25-year-old brother. So the moment you see these are the keywords. You need to register it in your mind. Okay. So I'm talking about a single taxpayer supporting a 25-year-old brother. So brother is a child, by the way, okay? I remember that a brother is a child because child is your child, step brother, but whether it's a qualifying child or not, that we will see, okay? A full-time graduate student who lived with her entire year and had no taxable income. Constance, so the brother's total support for the year was 24,000, out of which 14,000 was tax-free scholarship paid his tuition. The taxpayer paid 6 and the brother paid 4 from his own savings. Tell me how many dependents do you have and what is the filing status? Yes, guys, tell me what is the number of dependents and what is the filing status? Number of dependents, filing status. Now see what we are doing. Is that person a qualifying child? First you tell me that. Less than 24 or less than 19. So it's not less than 24, will not be a qualifying child. Can that person be a qualifying relative? So what was the test for qualifying relative? PORTUS. The person is not filing a separate return, only citizens done. Is that person related to you? Yes. So we don't need this to be applicable. So it's either R or T. Remember, this is not both. It's either R or T. If the person is related to you, that person need not stay with you. But if that person is not related to you, that person has to stay with you. Taxable income, the person is not having any taxable income. So this is also met. Support. Now this is not your child. This is not your child or your stepchild. This is only available for your child or the stepchild. So you will not exclude scholarship. In that case, what is the provision saying? That in that case, the provision is saying the total support is 24, out of which you are providing 6. So you are providing 6 out of 24, which is only 25%. So the support test is not met. And if the support test is not met, the person is not a qualifying dependent. If the person is not a qualifying dependent, the person cannot be a qualifying dependent. Something else has to be added for that person to be an HOH, right? So that is not going to be applicable. This becomes 0 and this becomes single. Is this clear to everybody? Shikha, is this clear?
Yes, ma'am.
Clear?
Yeah.
So now scholarship is clear to everybody. Rajesh, is this clear? I don't see you answering anything. Clear? Okay. Now look at the third question, okay? Look at this question now. And I think by now you guys can also step in and try to answer the question, okay? Raj and Meera file a joint return. They provide 100% of the support for their 16-year-old son who lives with them and for Meera's mother Sunita, who has no taxable income and lives alone in a separate apartment that the couple pays for. Now, whenever you look at the question like this, out of 2, I can immediately go and answer one. Can you tell me which is that one that I can immediately go and answer? Very good, Hanuman. So I know this is MFJ because dependency and all of that is relevant when I'm single. But the moment it's a MFJ return, then yes, dependency is there, but the filing status will always be MFJ. Now tell me, how many dependents are we talking about? They provide 100% of the support for their 16-year-old son. So I know age criteria. So a residency scope, right? Who lives with them and Meera's. So one is your son less than 19. Everything else is followed, right? Residency done. Support, no support is being provided by anybody else. You is under, so SCOPE, all met. So the child is a dependent, clear. Meera's mother, who has no taxable income, lives alone in a separate apartment that Raj and Meera pays for. So, how many dependents are we talking about? Now, can you understand? Shikha, unmute. Have you understood this, Shikha?
Yes, ma'am.
Because in this case, it's a relative. So the relative need not stay with you. The moment you provide more than 50% of the support of the other relative, and if that relative is not earning a lot of taxable income, you can immediately use that relative as a dependent on your return. Is that clear?
Right.
And what is the benefit that this case will give you? At the max, you can get a dependent credit in your return. You are not going to get a status change. So the only benefit you can get is the dependent's credit, which we will see when we do the dependents. Is that okay? Okay. Now think about this and tell me what is the answer for the fourth one, okay? Rosalind's husband died last year. The moment you have death, your mind should be really alert. Which year's return is being filed, okay? So last year, the moment it is a death, I immediately become really cautious because I know it could be a QSS. Not remarried, and it was last year. So this is this year and another year I can claim in QSS if there's a qualifying dependent. Throughout the year, she maintained a home that was the year-round residence of a 7-year-old daughter, Ivy, whom she supports in full. The taxpayer also provides more than half the support of a widowed mother, Edith, who lives in her own apartment and had 4,200 of taxable interest income. How many dependents can you claim? What is your filing status? Can you tell me, guys? Please answer. Please write it as 4 and then give me the answer. 4 and then give me the answer. So how many relatives are we talking about? Daughter definitely is a relative. A qualifying child. Guys, write 4 and then give me the answer. 4 and then the answer. Not 1, 4. Yeah. So can you see, guys, everybody? One is a qualifying child, other is a qualifying relative. Why? If you are having confusion, initially I would want you to write everything. And please don't do it with your concepts. In your mind, revise all of those, okay? A residency scope, and then for a dependent, you go, relative, you go, it's PORTUS. So there are 2 dependents. and the status you will have will be a qualifying surviving spouse status. We will leave this question for the time being. Is this clear to everybody? Anybody, any questions? Is this clear to everybody? Okay. Now we will leave the next one because there's a concept that I have to take you through. Let's take the sixth one now, okay? Trevor and his ex-wife divorced 2 years ago. Their 9-year-old daughter lived in Trevor's home from January through August and with her mother for the remainder of the year. Trevor's ex-wife has the higher HAI, but the divorce decree is silent on who claims the child. Tell me, can Trevor claim the child as a dependent? And what will be the filing status for Trevor? Everybody. Give me the answer as 6, and then the answer, guys. Give me 6 and give me both the answers. How many dependents, if at all, and what would be the filing status? Shikha, what Trevor is who? Trevor is the taxpayer. Is Trevor a custodial parent? Ask yourself, what is the provision saying? The child's see, you guys, at the moment I mix things up, you're getting confused. Swarna, unmute yourself. Who is the custodial parent?
Trevor.
Sure? Trevor is the custodial parent? So if Trevor is the custodial parent, then of course, and is Trevor, see, the daughter lived in Trevor's home from Jan to August and with a mother for the, so Jan to August is how many months?
8 months.
8 months. So think about, so one thing is very clear that you are the custodial parent, you can claim the child as a dependent on your return. I don't care about the AGI.
Yeah.
But why not HOH? It is your child. It is your child who has lived with you for more than half of the tax year, right?
Right, yeah.
So why not HOH? Why single? Is this clear? You are the custodian. Yeah, tell me.
Yeah, the child moved back to her mother for the remainder of the year.
Yeah, but then what is the provision saying? The provision is very clear, right? What is the provision saying? The provision saying if it's must live with the taxpayer for more than 50% of the year.
50%.
Is that
Okay.
dependent child? So are you maintaining a house which for more than half of the tax year was the principal residence of your dependent child? The answer is yes. And is that person staying with you for at least 50% of the year? The answer is yes. So you will become an HOH.
Sure. Okay.
Is this clear?
Yes. Yeah. Got it.
Shikha, is this clear?
Yes, ma'am.
Okay. Others, Hanuman, what's wrong with you? You're not answering. Yeah, Pradeep, you're not answering. There's no point being invisible in our sessions, okay? So please be attentive. Don't fix anything. Okay, Shwarna, just tell me very honestly, all of you guys, did your judgment get influenced because Trevor was a man and not a woman? Had it been a mother, you would have been able to understand it really well. Is this clear or not? Am I wrong?
I didn't do that judgment, ma'am. But yeah, for some
Okay,
reason.
but in that case, then did you assume that the person has gone away forever with her mother?
Yes, that's
But
the thing.
even if that be the case, for this particular year, you have met the criteria, right?
That's right. Yeah. I should.
So please understand that this is law. You are not going to apply your emotions into it. You are going to go by what the law states. Is that clear?
Sure. Yeah.
Okay, everybody, see, it's very important that you study the two topics together. And if I mix the provisions for the two topics, it should not really blow you off. You should be able to apply separate provisions for each one of them separately. Okay, now let's look at the next question. B is single. Her cousin Felix lived in B's home for the entire year, had no taxable income, and was supported more than 50% by B. What is the filing status and what is the number of dependents that B can claim on his or her return? So again, in your mind, one thing is very clear, this cannot be a qualifying child. At the max, it can be a qualifying relative, which is PORTUS. Joint return done, only citizen done. Residency or relation or taxpayer lives with the the person has to live with the taxpayer for the entire year. Yes, the person has stayed with the taxpayer for the entire year. So that person need not be related to you by blood. So yes, I have followed T under a particular amount of taxable income. Yes. Are you providing more than 50% of the support of the person? Yes. So you are a qualifying relative. In that case, Shwarna, unmute. How can you be an HOH for a person who is not related to you? Can you be an HOH of a person who's not related to you?
Cousin is
Not
a
related to
relative.
you. No. Foster parents, cousins, not included. Okay?
Okay.
Not related.
So they can just be a dependent, but with the
Not a
filing status
HOH.
will be single.
Yes. So there will be one dependent and a single status. Is this clear? For each one of them, mention it separately. Take the provisions for dependency separately. Take the provisions for filing status separately. Okay? Okay. Next question, Pradeep, you would, okay? Douglas is single and provides more than half the support of his 30-year-old son, Aaron, who's permanently and totally disabled and lives with D all year. Aaron had no earned income. What is the filing status and what is the number of dependents that you could take in your return? Pradeep, your turn. Pradeep, are you there? Guys, don't. Yeah, but I cannot hear you. Do you have a mic or you don't have a mic? Yeah, explain.
Dependent one and the filing status is HOH.
But why dependent?
Like is like disabled.
So so you have to use the right term. This person is a qualifying child, right? Because it's
Yes,
disabled, that is why the age criteria will not be applicable.
correct.
And all the other conditions are met. So qualifying child, that means one dependent will definitely be there. And if it is a qualifying child, are you supporting that? Is that person staying with you for more than half of the taxpayer? The answer is yes. So you become a HOH, not single, right?
Yes.
Okay. Next, Rajesh, you will do. Simon files a joint return with his spouse P, who had no income during the year. They have no children or other individuals living with them. The taxpayer wants to know how many dependents he may claim as a result of supporting the spouse. Rajesh? Don't waste our time, guys. Yeah, Rajesh, tell me. Are you there? Please. Rajesh, are you there? Can you unmute yourself? Shikha, see, this is the time when you are falling. Think. Can you take the dependency for your spouse? You can't take the dependency for your spouse, can you? No dependency for your spouse. So zero
Ma'am,
dependency.
but all the conditions for port US is being met, right?
But that is for a relative. Cannot be your spouse with whom you are filing a joint return. Your spouse can never be your dependent. Please remember that. Because you're filing a joint return, right?
Okay.
So your name is coming with that. So basically it is both of yours return. Then how can you claim each other as a dependent in your own return if it is your return? Is that clear?
Got it.
So never, a spouse can never be a dependent and your status would be married filing joint. Okay, this is a chocolate question. Whoever answers first, awesome. Okay, if you can't, it's okay. We'll understand this, but try and answer this. G is single and maintains his own home where his 19-year-old son, Travis, lives. Travis works full-time as a fitness trainer. He is not a student, earned $22,000 during the year, and G provides all of Travis's support. So I have the first person. Don't rush, okay? Go a little slow. Don't rush, go a little slow. So here I have one person who's a son, and I'll have to figure out whether that person is a qualifying child. So we'll take a residency scope. And then I can take that person as a qualifying relative, where it will be PORTUS. So let us see what's the first one. Okay. So is the son, is Travis a qualifying child? Yes, no, guys? What do you say? Is Travis a qualifying child? Is Travis a qualifying child? Everybody, what test has he not met? What test has he not met because of which the person has to be less than 19 years? Exactly 19? No. And the moment he is not a qualifying child, is he a qualifying relative? Is Travis a qualifying relative? What do you guys say? Is Travis a qualifying relative? Rajesh, very nicely. See, this guy is making 22,000. If that, which is much more than 5,300. So Travis is neither a qualifying child nor a qualifying relative. So you're going to leave Travis completely. The taxpayer also provides more than half the support of two other people. His widowed sister, Carol, who lives in another state and had 3,000 of taxable income. So son, sister, father. There are three people whom this person is supporting. Son is neither a qualifying child nor a qualifying relative. Sister. Is sister a qualifying child? Is sister a qualifying child? Why? Why is sister not a qualifying child? So sister is not staying with you, right? So the residency is not being met. So sister is not a qualifying child. Is sister a qualifying relative? Is sister a qualifying relative? The sister is a qualifying relative? Yes, no. Swarna, if the sister is not living with him, doesn't matter. If his sister is related to him and she's not making a lot of taxable income, that means the sister would be a qualifying relative. Why no, guys? Think. What is the provision for the support test? Age. So P precludes joining a file return. Done. Only citizens. Done. Either related to you or stays with you for the entire year. Related to me. Done. Under a particular amount of taxable income. Done. Sorry. This is not relevant to me. Under a specific amount. Done. Is the sister providing more than half of own support? Let us see what they're saying. More than half of the support of the two people. Sister, done. So sister is a qualifying relative, guys. Is this clear or not? Everybody, do not skip the jump. Please write every step. Cross tick, and then arrive at the answer. Yes, Rajesh, you have something to add? Rajesh, I cannot hear you. Is there a question? You can write it in the chat panel. Is everybody clear? Why is sister not a qualifying relative? Sister is a qualifying relative, right? Father, okay? Father who lives alone in his own home in the same town and whose only income is non-taxable Social Security. G pays more than 50% of the cost of maintaining the father's household. How many dependents may Gerald claim and what is his filing status? Is father a qualifying relative, guys? Father is not filing a joint return, citizens of US. He is related to you, so I don't care where he's staying. He's not earning a lot of taxable money, and you are providing more than 50% of his or her support. So the father is also a qualifying relative. So I know for sure that I have 2 dependents. I am single. The moment they tell you you are single, you have to be very careful now. Chocolate question is, what is your residency status? Can you tell me, guys, what is your filing status? See, the moment you do this, then ask yourself, I can take it either for sister or for father because they are qualifying relatives. Then you go to the slide that talks about the provisions for, so you cannot be QSS. The only thing is now HOH. What is the requirement for HOH? If it's a qualifying relative, qualifying child, or a parent. Qualifying relative has to stay with you for more than half of the tax year. The qualifying child has to stay with you. Qualifying parent need not stay with you. Yes or no, guys? Everybody. Why single, guys? You're still not understanding. What was the provision for this? Dependent child must stay with you for more than half of the tax. So sister is a dependent child? No. Is sister a dependent relative? Yes. But is that sister staying with you for more than half the half year? No. So sister will not be eligible for HOH. But what about father? Father not needed to stay with you and you're providing more than 50% of support of your father and that father is dependent on you. Yes. So yes for the father. So the status will become HOH. Is this clear? You have to apply the provision of dependent first. Then out of the people who qualify as dependent, you will have to now see for the additional provisions of QSS and HOH. HOH is very simple. Dependent child must stay with you for more than half of the taxable year. Dependent relative must stay with you for more than half of the taxable year. Dependent parent need not stay with you at all. So this is a qualifying dependent and the parent, it's a parent who's not staying with you, but you are providing more than 50% of the support of the parent. So is that parent eligible to get you the HOH deduction? The answer is yes, it is the HOH. Is this clear to everybody? How many of you have got a big khichdi in your head right now? Tell me. How many of you? Is this clear to everybody? Anybody, any provisions till now which you're not clear of? Okay. Now let's go and see some of the other criteria. Okay. Child will include legally adopted child. Child will include foster child. So except for the QSS, foster children will also be included as a part of qualifying child. Relative could be anybody related to you by blood, but it will not include your foster parents and cousins. If you would see this, right? Not included. A spouse is never considered a dependent. We saw a question on this, right? Spouse is never considered a dependent. Okay, now this is one concept that I want to explain you. What is a multiple support agreement? Let us look at a question first. T who is single and lives in California has no income of his own and is supported in full by the following people. An unrelated friend, brother, and daughter. The unrelated friend is giving 48% of support to the person concerned. Brother is giving 43%, daughter is giving only 9%. Now, when more than one people are providing support, so that the total support which is given to a particular person is more than 50%, we say that it becomes a multiple support agreement. When none is giving more than 50%, but all together give more than 50%. See, the moment one person gives more than 50%, immediately you can take that person as a dependent in your return. But it's not one person, but multiple people who are taking that person, providing support to that person. So you would say that this is a multiple support agreement. So technically, an agreement becomes multiple support when it has at least two people who are either a qualifying relative or a qualifying child provided more than 50% of the support in total to the person, but none individually provided more than 50% support alone. What is very important is I can still go and claim that person as a dependent on my return, provided at least each should give you 10% support. Even if I'm not giving 10% support, my name will not be there as a person who could claim that other person as a dependent. I should not provide, any one person should not provide more than 50% support, because in that case, there's no question of multiple support. Only one person can go and claim the person as a dependent on his or her return. Joint contributors are required to file a multiple support declaration under Form 2120. So see, I'll give you an example. See, let's say that I have a father and we are 3 siblings. And each one of them are providing 1/3, 1/3, 1/3 support to my father. Now, in that case, none is providing less than 10%. None is providing more than 50% alone. So all 3 of us become eligible to claim my father as a dependent. But in a year, only one person can claim. And the other 2 will file a support and say, okay, this is a form which says that this year we have given the right to me. So let's say 3 people, me, my brother, my sister. So both of them will file a return and file this form and give it to me saying, okay, you take that person as a dependent on your return this year. Next year, maybe I will file a support and give it to that person, my brother, and the 3rd year, my sister will get it. So the idea is none can provide more than 50% alone. Each should give at least 10%, and the others should file a multiple support declaration. So look at this question. An unrelated friend providing more than, so first of all, I cannot claim any dependent if that person is unrelated, right? Goes away. Daughter is giving less than 9%, so less than 10% goes away. So the only person who can claim this dependency is the brother in our example, because this is the only person who's provided the support. Okay, let's look at one more question. I think it will become really simple after this. Look at this question that we left behind. Look at this question, guys. Gloria's mother, Rosa, has no income and is supported entirely by 3 people. G provides 15%. The brother, so there is a parent who is a mother. The mother has a daughter. The daughter is providing 15% support. The son is providing 45%. And there's a family friend who's providing 40%. No one individually provides more than half, and the brother and the friend sign Form 2120 agreeing that the taxpayer can claim the mother. So in this case, see what is happening? The friend will not be considered, because in order to claim somebody as a dependent on your return, that person has to be, the person has to be related to you, right? So the friend will go away. Now we have the son or the daughter. Each has provided at least 10%. So now I know that it is the son who can get, but the son has signed up and told it that Rosa can claim. So there is a multiple support agreement where more than one people are providing the support. There's one person who's claiming that deduction. The others are foregoing or promoting that, okay, this year let this person take that deduction. So what will be the number of dependents that the daughter can claim is 1, because the others have relinquished the right and it now goes to you. But this is very, very important, guys. I can have somebody as a dependent on my return, but that will automatically not give me the HOH status. The status would still be single. My status cannot become HOH if it is a multiple support agreement. For status to be HOH, you need to have a single person giving more than 50% support of the other person. So for a multi-support agreement, even though you can claim that person as a dependent on your return, you would still not be able to get the HOH status. Is this clear, everybody? So that's a multiple support agreement. One second, I think with this, yeah, we've completed this sim. Is this clear to everybody? Okay, just remember, each should provide more than 10% and none should provide more than 50% alone. Okay, so that's the multiple support agreement. One second. Yeah. This we've already explained. If there is a child of a divorced parent, the person who's a custodial person, only that person can claim the child as a dependent on her return. It is not determined by the divorce decree, and it may not be the one who has provided more than half of the child support. It may be anything. At the end of the day, it's a custodial parent who has the primary right to claim the other person as a dependent and also to get the HOH status. If both the parents have equal custody, then we will go to the money. So if both the parents have equal custody, then the one which has the higher AGI, that person will report the child as a dependent on his or her return. Okay, again, don't prorate birth, don't prorate child. You will get the deduction for the entire year. You will not be asked to prorate the birth of the child or the death of the child. Okay, there are some small caveats regarding how do you process the death, but that's a different. Okay, is this clear? What I'll do is probably I'll take a quick 5 minutes break. I will convert the third sim as a practice sim, guys, okay? Because it's a good sim and I want you guys to practice it. This is the sim. I have given you 3 exhibits and you will have to choose the sections also here. The section references are given. You have to choose a section references here. And then you will have to make this. So I'll convert this into a practice sim, but you should do it only after you've understood the provisions of what we already did for both the topics that we have completed so far. One is filing status and the other is HOH status. Is this clear to everybody? So with this, yeah, we'll take a quick 5 minutes break and then we will start the next topic, which is the overview. Okay, so let's take a quick 5 minutes break. Shall we start? Shall we start? Okay. Okay, now see what we're trying to give you is an overview. Okay, so what we're going to do is now, it's like saying I have to do individual taxation. I will come out of the entire thing, have a drone's view, and then slowly we'll go to that particular area and we will discuss this in great details, one by one. Okay, so how do you calculate individual taxation? So what I'll do is I'll first give you the perspective, a complete visual of what we are going to do. And then I'm going to link it to your form 1040 so that in future you would exactly know, okay, this is the area that I have to cover. So first, again, we are going to spend some 3-4 sessions on understanding what's a gross income. Now in the US, please understand guys, it doesn't matter whether the source of income is legal, illegal, earned, unearned. The idea is everything gets included in gross income. First, you report everything to me as IRS as a part of your gross income. Once you have that, I will now tell you, okay, this is a first layer of deductions that you could take. And if I look at adjustments, something is very peculiar about adjustments. What is that? We say, okay, I will give you a Dhobi list of items which goes and hits the adjustments. But please be very mindful that these amounts, even if there's one of the list, you just take that. Okay, so any one can come here. So we don't see anything in complete big thing. If you have an IRA, go and take the IRA deduction. If you have a student loan interest deduction, take the student loan interest deduction. So any one of these deductions, I have given you a big list. Any one of those, if you have, go to that list, figure out what is the number of deduction or what is the amount of deduction that you're eligible, and get that amount as a deduction from your gross income. So first put everything in the bucket. Then I've given you one hole which has 11 small mini holes. If any of those 10, 11 provisions are there, take that particular deduction and take it out. Okay, so what we're doing is imagine a big faucet like this, and I've given you holes in that faucet. So first put everything in gross income, and then in your adjustments, I've given you some defined holes. And in each of those defined holes, I have only a particular amount that can pass that hole. Take that amount, and if it is there, you take that as a deduction and then you remove it. Now, what you get after it is termed as an AGI. Now, this is a very important threshold. So what is important is anyone, always, automatic, any amount, anytime, any year. So any amount, if you get as adjustment, you get it above the line. What you get after this is called adjusted gross income. Guys, just give me 1 minute, 1 second. Yeah. So see, this is an important yardstick. Why? Because this is a yardstick in which I'm going to stratify the community in the US and say, see, you are rich. So, okay, I'll give you one example. In India, we have this LPG subsidy that is applicable to people. What is LPG subsidy? I have these gases, the LPG cylinders that are given. And the government has given me a form saying that the moment if your income as a family is more than 10 lakhs, please let us know. We will not give you LPG subsidy. So what we've done, we've stratified the population of India into 2 categories. One who will be eligible for the subsidy, one who will not be eligible for the subsidy. Why? Because 10 lakhs is a determined amount. Similarly, in the US, there are so many provisions which I will phase out if you have a very high adjusted gross income. That is the reason taxation in the US is termed as progressive taxation. Everywhere in the world, taxation is progressive, which means what? As your income increases, you will get less and less of deductions, and the incidence of tax in you will also increase. So you take everything, you remove the first layer, which is adjustments. Then what you get is a very important threshold called adjusted gross income. After you get the adjusted gross income, now I've given you another hole. But this hole is like a min. So it is like this, you know. What is this? Sorry. It is like this. The second hole is like this, where in the first one we will do a beam balance kind of a test. What is that test? That test will say, okay, figure out whether your standard deduction is more or figure out whether your itemized deduction is more. So I have holes, but all of these holes will be mapped against the standard deduction. Whichever is high, I will take that. Whichever is low, I will scrap that. So I have given you one big blanket figure. Take that blanket figure. But in itemized deduction, which is also termed as below the line deduction, I will take all the items. Again, there's a big list which is given to him. Two C's, 2 M's, ITU. Basically, 6 or 7 items are given. But these 6, 7 items cannot be taken in isolation. You will have to map it as a group against standard deduction. And if your group is more, take that, delete the standard deduction. So it's like saying I will take, if this is heavy or this is heavy, whichever is heavier, you will take that, and only that portion will be allowed to come out of your gross income, of your adjusted gross income. So remember, adjustments, I don't care about the others. I've given you a big list. If any one is there, you take that deduction. For below the line deduction, which is standard deduction or itemized deduction, I will put it together, balance it. Whichever is more, I will take that as a deduction and I'll scrap the other. Now, this is very important. Later, which is there, which got introduced in 2025, they have given us 4 more deductions. Okay. So there are 3 below the line deductions actually. One is this. I call it standard deduction or itemized deduction, whichever is more. Now these 4 are actually clubbed and we call them additional deductions. Clubbed means they're not clubbed actually. They're not dependent on one another like standard deduction. But we view them as additional deductions which got introduced in the year 2025 and which they have continued in the year 2026 also. So what they're saying, there are some deductions for tips, some deductions for overtime, car loan, and enhanced deduction for seniors. Each of these has a provision. If it's applicable to you, you take that as a deduction. So one is gross income. So we'll study first what's the item of gross income. How will you tax rent? How will you tax salary? How will you tax dividends, interest? Everything we will study in gross income. Then we will study what are adjustments. Then we will study what's a standard deduction, what is an itemized deduction. Then we will study what are these additional deductions, tips, overtime, car loan, enhanced deduction. Then you will study what is a qualified business income deduction. Now, what is this income, guys? Again, it's a very, very complicated provision in regulation. What it essentially means is, see, what has happened was in the US, somewhere it was realized that US had a very high tax rate on the corporates. Can you tell me what is the tax rate on corporates now? Anybody? In the US, what is the corporate tax rate for the corporates? Anybody? How much tax do the corporates pay? It's 21%. Okay? And earlier, it used to be 35%. So in 1 year, they scrapped the tax rate from 35 to 21, but that was applicable only for C Corps, who are public limited companies in the US. So companies which are C Corps, for only those companies, the tax rate fell down from 35 to 21%. Why? Because we wanted to bring up this whole Make in America campaign. The entire manufacturing was moving out. The businesses were moving out of America because of a very high corporate tax rate. And we didn't want that. So what we did, the first thing that we did was we slashed the corporate tax rate from 35 to 21. But then we realized that we have to do something for other small businesses also, because there is this concept of flow-through taxation in the US, which means for partnerships, for sole proprietorships, for limited liability companies, for LLCs, for all of these flow-through entities, the information return, the return that you pass, which is 1120, 1120S, 1065, these are only for information. Ultimately, all of these The individuals will pay tax on their individual income tax return. What do you mean by this? See, in India, if I'm running a sole proprietorship, I don't pay a separate, my company does not file a separate return. I will include it as a part of profession and gains income, business, profits and gains from business and profession. I will include it as a part of my personal income tax return and I'll pay tax, right? The same thing happens in the US for all the entities except for C Corps. So what we did for all of these flow through entities, right now, even if you don't understand it very well, it's okay. I'm just introducing the concepts. We will discuss this in much greater details when we are at that provision. For all the entities except C Corps, that means we are not talking about C Corps. We're talking about every other entity apart from C Corps. For you, if the business generates income, we don't want you to get taxed at 37% tax slab rate, which is the highest tax slab in the US. So for only the income coming out of that business, we will give you a deduction called the QPI deduction. So what we are doing, we start from gross income. We'll study all of gross income. Then we will study adjustments, arrive at AGI, deduct standard deduction or itemized deduction, whichever is whole. Then we'll deduct additional deductions, tips, car loan, overtime, enhanced deduction for seniors. And we will get a deduction for QPI, which is the flow-through entity deduction, only from the part of the business income that is generated from the flow-through entity. So only the business income which is being generated, if it is from flow-through entities, I'll give them a QPI deduction, qualified business income deduction. After deducting all of this, what I will get is taxable income. So when we study individual taxation, we will study gross income, adjustments, standard deduction, itemized deduction, QBI deduction, tips, overtime, car loan, enhanced deduction for seniors. What you get is taxable income. Then we will apply the tax slabs depending on what is your filing status. And we will calculate a federal income tax. We will pitch it against alternate minimum tax. Whichever is higher, we will pay that. And we will add all the other taxes that is applicable to you. So this could be net investment income tax. This could be self-employment tax. All the other taxes which are applicable, I will add. From there, I will reduce the credits. And some of these credits, you will get higher if you have a HOH status. Now, we know what's a child dependent. So there are credits which will be more if you are an HOH. So you will get the credits. And from there, we will remove all those items such as advance tax and the tax that you've already paid by way of TDS. In India, we call them TDS. In the US, we call them withhold, the taxes which were withheld by your employers. So we will reduce all the payments, and then what you will get will be that amount of tax due or the amount of tax refund. So over the next maybe 12, 13 lectures that we will give, we will take you through each one of these provisions in great details. Okay, we will take each one of them and we will drill this as a concept, so that by the time you finish this, see, if I show you the, see, can you see this? We have done what's the filing status. So one part of the form done. We've done what's dependent, another part of the form done. Then we will go to income and we will describe a lot of incomes here. We will start with what's a wage income. Then we will do what's a, see, tip income, wage income, household wages income, adoption benefits. So a lot of these we will do. And then once I get all of that, I will, see, I will add all of this and I will get total income. So this is the first thing, which is total income. Here you will see there will be some schedules that will be flowing into it, like your dividends, passive income is Schedule B. So you will take that figure from Schedule B. Some figures will come from Schedule C. Some figures will come from Schedule E. So different figures will flow down to different schedules. From total income, I will give you the adjustments. This is what we will be studying. So there's a schedule. I'll show you the sub-schedules also, okay? So we have the master form. So 3-4 forms are very important, guys, okay? So if you go to your IRS forms, you will see first we did the individual. Then we have Schedule 1, 1A, 2, 3. 1A is a new schedule for which they have still not provided you the revised form. Can you see this? All the other income, we will add all the other sources of income and then we will add this up and we will take it in Schedule 1, which is the Form 1040. Similarly, in adjustments, we will deduct all the adjustments and ultimately we will route it in Form 1040. So every other form will get routed in Form 1040 after this. So we have Schedule 1, and if you look at Schedule 1A, since they got new deductions, they introduced a new schedule. See? Can you see these additional deductions that you will get? Tax on tapes, tax on overtime, all of these additional deductions is being reported on Schedule 1A. So what we have to do, we have to first understand what's gross income. And when we are doing it, we will also study Schedule 1. And there'll be a lot of other schedules, Schedule B, C, D, E. So B is for portfolio income, C is for profits and gains from business and profession, D is capital gains, E is rent income. All of this will flow into gross income. Then we will study again adjustments, the details of which will be in Schedule 1. We will flow through it in Schedule 1040 and then we will arrive at its AGI. Now, once you've arrived at AGI, now you want to know whichever is more, standard deduction or itemized deduction. Now, for itemized deduction, you will go to the next schedule. See, if you go to Schedule 2, see, Schedule 2's other taxes. Okay, all the other taxes are coming in Schedule 2. And then you have Schedule 3. Can you see? All the additional credits and payments will go to Schedule 3. So here, if you look at it, one second. So here, if you look at it, Master Form 1040, you will have standard deduction, you will have itemized deduction. Where is itemized deduction coming from? Itemized deduction is coming from Schedule A. So Schedule A, B, C, D, E, F probably also, and then Schedule E, and there's a small part which is Schedule SC. I've given you all the most important forms in the IRS forms list. But you get the idea, right? You started with gross income, then you deduct adjustments, or you arrive at AGI. Then from AGI, you will reduce standard deduction, itemized deduction, whichever is higher. Then you will reduce your QBI deduction and all of those additional deductions, 4 new deductions, which is there in Schedule 1A. And then ultimately what you will get is your taxable income. Then you will calculate your tax. And from this tax, you're going to add all the other taxes, which is given in Schedule 2. So Schedule 2, Schedule 3, you will take those. To Schedule 2 is all the other taxes. And then Schedule 3 is all your additional credits and payments. You will get all of that. See, this is the payments. This is the payments part. Okay. And all your refundable credits would come here. Ultimately, what you will get is a tax due and your tax refund. So it's either tax due or your tax refund. So the entire thing, we will take it step by step by step. We'll take each individual portion. So just the way we did filing status, similarly, we will do dependents and all the other items in a slow way, but in a very, very steady way. And as I told you, keep revising whatever you finished, because otherwise you'll realize by the end you finished everything that you started with. And that's not what we could afford.